Right? You know, I'm early. It's 3 some in the morning. And I'm early, but better now than never. Here we go. Traditional investment vehicles, stocks, bonds, mutual funds, index funds, and ETFs. And the name of this book is 101 Investing, Friendly Investing. Here we go. And like I said, we're going to read page by page, day by day, slowly but surely. We're not going to skim through. We're just going to read it slowly but surely. All right. Traditional investment vehicles, stocks, bonds, mutual funds, index funds, and ETFs. Buying a share of stock is like owning a small piece of a company. If you buy one share of Apple, you truly own part of it. Stocks represent ownership, and companies sell these shares to raise money. When people talk about the stock market, they're talking about all the shares from thousands of companies traded each day. Investors can choose stocks from renowned brands like Nike, Microsoft, or Starbucks. Stocks make money in two ways. If the company pays a part of its profits to shareholders, called dividends, or if the stock's price rises, and you sell it for more than you paid. For example, if you buy a share of a retailer like Walmart for $100 and sell it later for $120, you make a $20 profit. Dividends are usually paid out every 3 months. Some companies don't pay dividends and instead reinvest profits to grow the business, which can also make the stock price increase. Owning stocks means taking more risk. If a company does poorly, the value of your stock can drop, markets can swing, and occasionally a company's stock price falls even when it's doing everything right. The stock market as a whole can move up or down quickly. So stocks are best for people who can leave their money invested for at least 5 to 10 years and handle ups and downs. You don't need a fortune to buy stocks. Many online brokers let people start with as little as $10 or $25. Some even sell fractional shares, which means you can buy part of a share if the price is high. Stocks are bought and sold on stock exchanges, such as the New York Stock Exchange, which is in letters NYSE, or NASDAQ, usually through an online account. Stocks are popular with people who want their money to grow over time. Historically, U.S. stocks have returned about 7% per year after inflation, but this isn't guaranteed every year. Some years see strong gains, others see losses. Buying a bond is like lending your money to a company or government. When you own a bond, you are the bank, which I never knew about. In return, the borrower promises to pay you back later. The date is called maturity and sends you interest payments along the way. That's interesting. Bonds are safer than stocks for most investors, but no investment is completely safe. We're going to highlight this right here. No investment is safe. It's completely safe. Just as a note to keep that in mind, no investment is completely safe. Why? Because investments is risky, but it can pay off too at the same time. Governments, cities, and business all sell bonds. The U.S. government issues treasury bonds, which are considered very safe. Companies sell corporate bonds to fund projects, and cities offer municipal bonds to finance things like schools or infrastructure. Each type carries a different level of risk, but all share one feature. They pay regular interest, usually every 6 months. Yeah, so that is different because we just read that dividends, stock shares pay like every 3 months. And they pay every 6 months. Yeah, bonds. Bonds generate returns in two ways. generate returns in two ways: through interest payments and by selling the bond for more than you paid. Most investors hold bonds for the steady income. Yields vary over time. U.S. Treasury bonds might pay 2 to 4% annually, while riskier bonds often pay high rates. The main risks are that the borrower might default or that rising interest rates could reduce your bond's resale value before it matures. Bonds typically require higher minimum investments, sometimes $1,000 or more. You can buy them through brokers or directly from the issuer, such as on the U.S. Treasury website. Bonds are a solid choice if you want greater stability and a predictable income stream. Okay. A mutual fund is like a shopping cart full of investments. Instead of choosing a single stock or bond, you buy a share of a mutual fund, and a professional manager select dozens or even hundreds of investments for you. The fund gathers money from many investors, pools it, and buys assets according to its stated goals. There are mutual funds that focus on growth, seeking stocks that may rise quickly, income choosing bonds or dividend paying stocks, and balance funds mixing stocks and bonds for a smoother ride. Never heard of that before, but okay. For example, a growth fund might own shares of Google, Netflix, and Amazon, while an income fund might buy government and corporate bonds. Mutual funds make money from the same source as stocks and bonds: rising prices, dividends, and interest. Some require 500, 1,000, or even less as a minimum investment, making them accessible for beginners. They're bought directly from mutual fund companies or through online brokers. Tripping. A common myth is that mutual funds are just for experts. In fact, they're a simple way for everyday people to spread out risk and let someone else handle day-to-day decisions. Beginners often like mutual funds because they can get a diversified mix with one purchase. Stocks have more growth potential but more risk. Bonds are steadier but don't grow as fast. That's another one to highlight. Okay, there we go. That's something to keep in mind. And we're going to add a note to that. To keep in mind. And also another option, another opportunity available. Save that. All right. More growth potential, but more risk. Bonds are steadier, but don't grow as fast due to their diversification. Mutual funds help lower the risk associated with single investments. By mixing stocks, bonds, and mutual funds, an investor gets both growth and some safety, which is the foundation of a strong investment plan. These three tools each play an important role, and together they help people work toward goals like buying a home, sending kids to college, or building retirement savings. Holding stocks for several years can yield significant rewards, while bonds provide stability and mutual funds simplify investing for all investors. As mutual funds package investments together, they lead naturally to even more efficient options across markets, setting the stage for exploring index funds and exchange traded funds, which make a brand diversification, or which makes a broad diversification and low cost possible for investors. All right, that's the page that we read for today. Hope y'all enjoy my reading and hope y'all learned a little something, because I did. The next one will be tomorrow. Real estate and rights, property investments for every investor. That's the next page we're going to do. Until then, y'all take care of yourself, and I'll talk to y'all later. Peace.